the name of the podcast I have, which I don't know if I'll keep it or not, but it's The Motive, I think, is what I told you
The
before,
motive?
which is the motive, baby. The
The
motive.
why behind the
I
why?
look at the definition of it, yes, was reason for doing something, especially one that is not obvious.
Well, let's talk about that. Actually, I like the way that sounds.
That's a good definition, right? That's
Yes.
why I called it off topic originally. I'm like, that's not really good.
Why
Let's
the
go with something
motive?
that is.
Tell me why the motive. I like that.
Yeah, again, the definition, I really like the definition of it, which is the reason for doing something, especially one that's not obvious. And I feel like that's what we do every day is we try to explain to people something they might not know about, right?
Yeah.
Like, for example, a rate cut and what it really means, right? And why you would do something. And you might not know why you should do it or what you shouldn't do.
Yeah.
So anyways, that's the reason I like it. It's like everything we do is solving these problems or finding a problem. And most people only know what they saw on social media or their friend or family told them, or they don't really know the whole truth. And they do stuff without having knowledge or education behind it. So
yeah, I think the motive is interesting because sometimes when you go to work with someone or your customer, you're conforming to their motive, right? Does your motive align with their motive? That's the trick. That's the magic, right? It's can you get that symbiotic relationship of motives where, we kind of have this same goal and we're kind of trying to get the same outcome. And I think that's when things work best. It's tricky when you go to work somewhere and it's like your motive is, you want to get paid. Their motive is they just want to use you until get to the next one. That's why we're pretty fortunate, to be in a place where you can align motives.
That's a good point. When you look at, you can flip it on both sides because that synergy, that understanding the other party, right? If you're at a company or talking to a client or whatever it is, it's got to go both ways.
100%.
You ever see like the sales guys that just sell like they're selling cars, but they don't really know what the person's real,
they want to
their motive
the test drive,
close the deal. They don't really care to help somebody.
Oh yeah, no, not at all. That's the way it goes. I sold cars. That was a great introduction into mortgage lending because
is that the sales introduction for you? Is that how you got started?
Potentially, yeah, I think so. That's the real sales because when you think about it, it's payment, right? When you're selling a car, it's ultimately about payment and affordability and leveraging that. And then when you go, that's how I got started. True story is I sold a car to a gentleman who worked at Transamerica Finance, which was kind of the early days of mortgage, not non-bank mortgage lending. And he's like, "You would be great at mortgages, man." And I was like, I don't know, man. I'm loving this car business. Cars are fun, dude. I love cars, And he's like, "Yeah, but you don't have to work weekends and, all this stuff." So it was pretty interesting.
That's what got you in. Everybody in loans gets in like some way like that.
They said too, they're like, "Oh yeah, you won't work weekends or nights and, you'll be on the golf course twice a week." And that was all a lie. I worked nights and weekends. The last time I was on the golf course, I was cutting the grass there. I don't know. I never get out on the golf course because I'm working all the time, So interesting though, for sure. It's affordability. It's payment savings. Can you help people, meet their needs? The house meets their needs. The car meets their needs. You got the car to go to work. Go to work to pay for the house. Everything's tied together. That was always a really good experience I found in early finance companies. His mortgage is very specific, but in the old school days, they would look at the whole thing and they'd say, "Okay, well, we'll make them the mortgage, but we're going to pay off the car. And the reason we're going to pay off the car is so that, we give them a lower monthly payment and, we can always have that carrot of the car over them." And it just was an interesting way of looking at credit and the way credit, was decisions were made, It was not like some secret black box that you plug it into DU and wait for an approved eligible. It was a guy. It was a guy or a gal that was sitting in an office somewhere, and they would look at it and they would make their opinion. And sometimes it didn't make sense, but typically it was always the right decision. It's pretty interesting for sure.
Not as regulated or formulated as mortgages, pretty much, right?
Oh no,
plugging it in and does it approve or not? There we go.
Yeah, I a funny story. I saw a guy one time. He must have had 20 credit cards. They were all pretty much at the limit, right? Paid paid every one of them on time, never late. And for years, paid him for years and years and years. And I'll never forget, I asked the guy, I'm like, this guy wants a personal loan. And I mean, he's maxed out. And I'm thinking I'm smart. I'm like going to show the old dog, like, hey, we're going to pass on this one. He's like, no way, man. We're going to lend this guy the money. I'm like, what are you talking about? He's like, this guy's never missed a payment. Look at all the debt he's carrying. You know, he's like, this guy's a sure thing. I mean, he's going to pay. He's a payer. He goes, that was always the comment too. He's a payer. He would pay. I was like, okay, whatever, dude. Sure. I mean, he was, and again, there was some wisdom in that, right? He ended up being a payer and he paid. And that was it. But like today, that would never happen in a million years. So
yeah, no. Well, there's different types of people. It reminds me of an ex-girlfriend, her dad, who had his own business, bunch of stuff going on. But he's like, I only like working class because they are always payers. Yeah. He's like, high-end people, they feel like they're too good. Like if you're renting a house to them or something, right? They don't care if they mess it up and they leave, they'll go get another one. And, you know, obviously below welfare class style is people that never pay. So you find that perfect person that's a payer, the working class person. They always pay their mortgage, their rent, their bills, and everything on time, even though it might be month to month. And it's a good client from an underwriting perspective, at least, right? That you would trust them.
Yeah, I mean,
to lend money to.
It's interesting.
Unfortunately, computers don't tell us that part, though.
No, but it's interesting, man. Like it's a real thing. Like sometimes there's a certain amount of entitlement, or there's strategic default. I think sometimes you get people that just like maybe they're high net worth, high income, or not, or they just think they're smarter than the system, and there's a strategic default to get a desired outcome. And I'm always like, why do that? But you always hear the story. Billionaires typically have filed bankruptcy several times along the way. That's not something I personally can subscribe to. I always believe you pay your debts. And I think a lot of the folks we work with, there's a commitment to the responsibility. And I think that's really key. The commitment to the responsibility is kind of a big thing. And I love working with people like that,
Yeah, I think everybody's got like a different goal or mission. I'm in a lot of investment real estate groups, like the one out here, the Inland Empire Real Estate Investment Club. And most of those people will stay away from any kind of regular financing that we do, right? They're private money. They don't care about credit scores. In fact, most of them probably have shitty credit, but one of the owner actually put a post out the other day. His credit's 836 and asking everybody how their credit was. And it's funny that everybody still has really good credit, but some of the big guys don't even care because they're not judged that way, right? They're judged on their experience, what they do, and basically who they know, which means they're not in the box of financing that we typically have to live in. So, right. But what do you think about, speaking of that, obviously a lot of people do a lot of different things and for different reasons and pay their bills. And obviously, we do refinances right now. And like when you're talking to somebody, what is the reason that they want to refinance? What are they looking at? We talked about this before. It's the dilemma, right? Like people got their low rate, but we're also at an all-time high of debt for consumers. And people are probably like having that difficult choice. Do I get rid of my low rate to pay off everything and have a lower payment? Or do I do it some other way? Or do I wait? What's your advice and suggestion with all the clients these days that have that going on?
There's a couple schools of thought, right? You refinance because you want to, right? Well, what's the want? The want is you want to lower your payment, you want to consolidate your debt, you want to achieve some kind of outcome goal. There's the want to. And then there's the other cohort of people. They refinance because they have to. And, the same calculation is baked into both of them, right? So the guy who wants to, you have to have it make sense for them, right? Why would you take a 3% rate and trade it for a 5% rate? Why would you do that? And, that's where you have to really look at the total of, the total payments, total of savings. What is the effect, right? What do you want to achieve? And, it's pretty easy to come up with a debt consolidation benefit, right? You have $1,000 in credit cards that you're going to make go away with a mortgage. Your mortgage payment is going to go up $500, your net savings $500. It's $6,000 a year. You're trading out the interest. Yes, you're going to pay more interest over the life of the loan, but in the here and now, you're going to save money on a monthly payment. That's a pretty easy scenario to explain and make sense of. It gets a little more complicated, for folks that they need the cash, right? They have an inherent problem, right? Maybe they don't have a ton of credit cards or they don't have a ton of credit availability or access, and they need $50,000 or they need $100,000. It's maybe to buy another property. Maybe it's to, school, health issues, you name it. Maybe the house just needs work and it's time to update. Update because you have to, right? So you got to trade in a 3% mortgage for 5 or 6 and, making that make sense. Well, how else can you get that money? Well, what does it do for you? And you got to look at it. Well, if you take that 100,000 out and put it into your home, and yes, you're raising your interest rate and you're going to pay more in interest, but what have you done to your home now? Now your collateral, your asset is worth that much more, right? And it's more desirable. So in one essence, yes, you could say you're paying a higher rate of interest, but on the other hand, you could say you've improved the value of your collateral, right? Which then makes, offsets. It's a true offset to the increased interest rate. So I think that's it. And rates, like we know most recently, and you can talk about this, is what have rates been doing for the last 2 months, right? They've been going down in anticipation of Fed rate cuts. And like, what are you seeing? Like the activity and rate drop happened when the Fed actually cut rates this week.
Yeah, I mean, this is a fun one because I said it yesterday, I think, to you, but to me, it's a trend. It's a hawk to a meme going on right now with the Feds dropping rates. I've seen advertisements of people saying mortgage rates cut by 50 basis points. And the hardest part to combat that is that you're going against the media and what people that are not educated are saying. And that's why what is the motive?
Yeah.
Especially when it's not obvious, because that's not obvious to what a lot of people is. The Fed rate was cut. But when I try to explain it to people, I've tried to make a few videos on this too. It's like, if you look at what the Fannie Mae, what the mortgage rates are and the Fed rates and what that margin is, and a healthy margin is probably like 2 to 2.25, right?
Right.
Like, I think that's pretty healthy. Yeah. So if I were to compare it when rates were 2.5% and 3%, well, the Fed rate was 0.15, guys. So that's like, we're talking, 2.25 to 2.5 margin. But right now, the Fed rate was 5.3, whatever it was, 5.25, 5.33. And we're giving rates out that are like 6%, right? Sure. So we're only having like a 0.75 margin. People don't understand the difference between what banks borrow money at and what banks lend money at is two different things, right? So 100%. So I think this Fed rate cut is great. That 5.3 is now 4.75. That's what banks are going to borrow money to be able to lend to you. But their margin is so skinny because they're trying to get volume, because they're trying to boost economies and stuff like that. It's not going to make a big difference on rates. I think people think it's the same thing. It's short term, right? If you have credit cards and car loans and stuff like that, it'll affect that a little bit. Right. But mortgages are based off of a different index, different rates that we look at for that. And people don't understand that. So even mortgage professionals and real estate agents, I've talked to over 10 professionals over the last 2 days that are like, aren't you excited about the rate cuts? And the funny thing is, the day the rates were cut, was that Wednesday or yesterday? Wednesday,
Tuesday,
right?
I think. Wednesday they cut them.
Yeah, Wednesday. And the Fannie Mae rates or the mortgage rates actually got a little worse that day, right? Sure. So we lost a little bit. So I think the rate cuts are awesome because it indicates that we're going in the right direction. But it's not going to make everybody get half a point lower on their mortgage right now.
Well, I mean, people don't know that when the Fed cuts rates, they don't cut mortgage rates. They cut short-term borrowing rates, right? Or the Fed funds rate. The Fed funds rate is the funds that banks use. Like, people don't understand what that is and what it's used for. It's for banks' overnight borrowing capacity. So to put it, in perspective, if you're Chase Bank or Bank of America, Wells Fargo, what have you, people have direct deposit. So let's just say every Friday, billions of dollars gets direct deposited to Chase. There's all the things that a bank does. And when they're between deposits and they're out lending, sometimes if they're really outstripping it, they'll go and borrow money on an overnight basis from the Fed. And it's in the billions. And I mean, you think about paying 5% on $1 billion even for a week. I mean, that's a lot of money. So when the Fed cut,
but that's short term, right?
It's very short.
The Fed rate. It's
very short. So when the Fed cuts rates, it's impactful and meaningful to them. And I think if you were to look at like auto loan rates, and just to kind of go back cars for a second, it's a short term loan, 3, 4, 5, 6, 7 years. You'll see those rates come down because that's a shorter term borrowing rate. But mortgages are tied to 10-year Treasury bond. Well, the 10-year Treasury bond is really an indicator of the economy as a whole, right? And as inflation went up, we saw what happened, right? The 10-year Treasury went up with it. Now, as hopefully inflation's cooling, you see rates coming up. We've watched the 10-year Treasury come down in anticipation of a Fed rate cut. Now, why is it tied together? Because the long-term prognosis is they do follow. They just don't necessarily follow in tandem at the exact same time, right? So the overall direction's down, but there were a lot of people caught off sides this week that didn't lock loans because, hey, Fed's going to cut. I'm not locking my mortgage. I'm like, dude, you better lock it, because mortgage rates weren't going to drop 50 basis points. I knew that. You knew that. And if anything, it was kind of buy the rumor, sell the news. Mortgage rates have been coming down for months. The cake was baked. It was all there. So when they actually did the cut that everybody expected, it was like, okay, no big deal. Rates went up a little bit.
Yeah.
And there was, I mean, I know.
Oh, yeah. It was already baked in.
Yeah, my phone rang a bunch. Briggs, why did rates not drop? Why did rates go up? I'm like, did you lock? Why didn't you lock? I told you to lock. You don't listen. Well, again, that's a good question, though. Like, when do you lock a loan? Forget this rate cut. When do you lock?
I lock a loan when it makes sense at that moment. Like I tell, and this is what I tell my clients: does it make sense for you? Because if it does, what do you wait? It's like having a line to buy a stock, but you're waiting for it to get 10 cents lower to buy it, right? Like people are always waiting for something extra, just like they're waiting for the conspiracy theory to come true and the end of the world to happen and all this stuff, which will probably never happen.
Right.
But I tell people, like, if it makes sense, do it, because it's not the end of the world. And if it gets better, you're going to do it again. If it doesn't, then you're going to be prepared. So to me, like we talked earlier, it's a want or a need, right? And obviously the need for something is a bigger problem to fix. And unfortunately, those people tend to be the ones that want to wait a little bit for something better.
Oh, yeah.
And I'm like, how has that worked for you lately? Because you're already in a worse position to having it it's not a want for you. It is a need. You need to do something.
Sure.
And if you're going to wait, you're going to need to do something even more, and it might not be in your favor. Yeah. So as you've heard the saying, the best time to buy a house was yesterday. The second best time is today. And the best time to take care of your financing was yesterday. The second best time is right now. Right. And if it gets better, you're good.
I love that. But that's like so on the money. Like that's what when it's sold, buy a house as soon as you can afford it. Like as soon as you can afford a house, buy one. Long term. I mean, if you bought a house in the peak of 2006, you watch the market crash underneath you during the Great Recession, and that $600,000 house is worth $300,000, and you were freaking out. That same house today is worth, in California at least, $1.8 million. And
most of the country,
and you've refinanced probably several times between 2010 and now, you're laughing because you bought it. And you probably felt really bad for a few years, and then you felt okay. And then you look back and you say, dang, that's why you buy a house. That's why you buy it. Don't worry about the rate.
If you want to know how that feeling works, just talk to any old time investors that have bought properties 20 years ago. Because most of the people I've talked to or interviewed about that, they say, I bought it and I didn't even know how I was going to make the payments. I didn't know how I was going to get through the next year. But you do, because that's human nature. Sure. Like even when you have nothing going on, you figure out a way to eat and live, and we move forward. And they're the ones that say, I didn't know how I was going to do it, but I did it. And the next thing you know, now I'm the millionaire with, a couple $1 million of equity in properties I invested in years ago. Right. So I tell this to everybody, like everybody's worried about these rates, rates are people financing home is usually short term, right? Like how often do people refinance or sell a home? 3 to 5 years on average. Yeah. People are so focused on it's a life-changing event that I have to make a decision on and I'm stuck in, that you're not. Prevents people. And even in these last couple years, 2, 3, 4 years, where everybody's like waiting for the market to crash because they're only thinking of the last thing they remember, which was the crash of 2008. Yeah. That's in their minds. They've lost out on what has it been? An average of 5.25% a year, even in these horrible rate years of appreciation nationwide, something like that. I think right around 5%. So a $500,000 house is costing you $25,000 a year on average, right? Is that right? Yeah. Math correct?
Yeah.
So you might have lost out on 100,000. So when was the best time to buy the house? When you could afford it back 2 years ago, 3 years ago, or yesterday.
And, I mean, in rent is just, I've never seen rent come down. It's like, oh, inflation's cool, rents are coming down. I'm like, where? Hardest thing is, spent a lot of time in the last year on the real estate side, and you look, and the demand for rental property is insane. There's not a lot of housing out there. There's just not a lot of housing for people. There's not a lot of affordable housing for sure. And just housing in general, when you think about it, even if the mortgage payments, like in the past, rents were typically lower than mortgages, coming out of the recession, rents were lower than mortgages. You could have made the case that made sense for you. Like even at $1,000 a month, $1,000 a month, 12,000 a year, 10 years, 120,000. Well, I could argue with you and say, if you bought that house in 2010, 10 years later, that house is probably worth double, what you paid for it. It's 500,000 is worth $1 million, and your 120,000 you saved is really only is 120,000. When you subtract that from the 500 that you would have made, you actually lost 380,000. That's the way you could look
Right.
at rent. You actually lost 380,000 over 10 years by paying $1,000 a month less because of the appreciation of your property. Plus, I mean, neither of us are accountants. At least I don't think, Jerry, you're not an accountant, are you?
No,
No. So
not. I play one on
the
TV,
tax,
but I'm not really
the
one.
tax
Yeah.
benefit, this for a mortgage interest deduction is, I mean, it's a game changer for people. It just really is. I mean, that probably
Well,
puts 1,000 a month
so
back in your pocket.
Well, yeah. So I guess the question is like, I think people know this stuff, right? Like we talk about how much you've lost out on and stuff like that. But what do you think prevents people from doing it? Do you think it's that they're waiting for something better? Do you think it's they're not qualifying? Or do you think it's just they can't see that far into the future to think about all these other benefits? Or is it just the scare factor? Like, because a lot of people seem like they're not like it's not scary, but they're scared to take on a $400,000 or $500,000 debt subconsciously, right?
Yeah.
Even though that's average and what everybody's doing.
I mean, it's
But what do you think prevents people from moving forward when they should?
always fear, but different fear, right? It's everybody. There's the person we just talked about. They're afraid the economy is going to crash. They're sure it's going to happen, yet they're not an economist. They don't, they don't make their living doing the economy, but they're sure a crash is coming. And so they're going to wait because they're going to miss the crash. So there's that person. That guy's scared. And then there's the other person. Well, I'm scared about my job. I don't know if it's secure enough. I don't know if I'll be able to, find another job. If I lose my job, what am I going to do? I'm scared because I'm going to put all my money that I have, I'm going to put all this money down. And then what am I going to have? Then what happens if I need that money? And then, it's always fear. It's fear for this reason, that reason. And you can talk yourself in or out of any. And the reality is, a lot of people just talk themselves out of it. Is it scary? Sure. But like, who can you count on? You can count on yourself. I mean, 100% of the time.
Yeah.
I mean, I tell people all the time, have you ever not done what you needed to do? Like, I figured it out when something went completely bust. You're sitting here in front of me today. You're talking about the idea of buying a house. Well, you got yourself here and you'll get yourself through what comes next. So, you got to be a little bit brave, but it's more important to just not be so damn negative. I mean, that's it. Because is a crash going to come?
No.
Eventually? Does anybody know when? No. And what happened after the last crash? I mean, I've done mortgages for 30 years. I've been through a couple crashes and they were scary and they were hard, but every time you double up. I'm looking to double up this time. So let's go do it.
Let's triple up. Let's go. Yeah, no,
Double down, baby.
I blame the schools for what that last one you were talking about, which is the fear of money, because I feel like nobody knows how money works and everybody wants to hold on to something they have, and that you lose it. But money it's just a leveraging tool anyway. So leverage it into your house, leverage it wherever you want to. It's scary for a lot of people. And I think for us as like the professionals, right? Half of our job, like we talked about, is finding the problem, or maybe it means isolating and really digging down onto whatever that fear is so you can overcome it. Because most people avoid what the real problem is. They don't want to go around talking like, oh, you're in a bad situation, a lot of debt. I don't want to bring that up, even though that's what we're trying to fix. And you have to be able to talk about money to clients if you're dealing with money. You're selling them money. Why would you be afraid to talk about it?
Well, it's funny. It's like, you know them too. Like there's a lot of these good people in the business and they know everything about lending and loans and ratios and whatever. And then, they come to me and they're like, I don't know why this guy wouldn't take it. The deal saved him money. It lowered his rate. It did this. It did that. It did. They go through the list of everything it did and then I didn't sell. And I'm like, well, let me talk to him. Yeah. And they roll their eyes. There's here we go again. Let's see. And everybody gets the popcorn and they waiting for me to get shut down. And I know going in, the one thing that wasn't talked about, which is, what is that person afraid of? What are they afraid of? Why? There's a reason, and everything makes sense like that. Like especially when you have something clear cut, right? Mathematically, it makes sense. You'd be silly not to do it. There's a reason or a fear in there. And you've got to now kind of be psychiatrist, psychologist, whatever, counselor. And part of it is getting someone comfortable enough to share that. When you're just hammering somebody with numbers, they're not real comfortable to be like, yeah, but I might be going through a divorce and I'm just not sure, if it's going to work out, and I don't want to refinance or to buy a house because what if I get married and blah blah blah, and they start going through this litany, and now you're getting this incredible amount of information, and that's when you can share, your experiences, your life experiences, your professional professional experiences, being in the business as long as you have, and sharing ways to help them kind of either combat the fear or come up with solutions to work through some of that stuff so they can take advantage of what made so much sense on paper, right? And I think that's kind of like really important. And I love having those phone calls too, because those are real. That's where a connection really happens. It's real, it's meaningful, it's impactful. Really feel like you help somebody, because you know the numbers are the numbers and they don't lie, and it's perfected. But you know the art and science of what we do is really helping people, and sometimes getting them comfortable enough to share what's going on and being able to educate them, help them, comfort them, so they can capitalize, right, and get to that financial destination they've been dreaming of. So that's it.
Yeah, no, I think that, well, and what you're talking about is literally just communication. It applies to any business that you want to do. If you're trying to do what business is supposed to be, which is to fix a problem or service a problem service somebody for a problem. So yeah, you're right. I think a lot of everybody just kind of stays on surface level, like you just said. I don't know why I didn't take it, because you're only trying to sell them this. You don't know the real problem. Good loan officers or good salespeople or good just communicators in general know how to think ahead and dig 3 to 5 levels deep than what's on that surface level, what that problem is, right? I love talking to people. I already know what the answer is going to be, and I'm already thinking about my next follow-up question before they even start talking, right? Like, you want to be ahead of that game and not just the blinders on, how do I get a paycheck, and give these people something.
But it's important.
Yeah, so I think that's
it's important to listen, because I'll tell you,
I mean,
when I back to my car days, which is really a valuable life lesson. I'll tell this story quick, but it's funny, but it's true, and it's very powerful. You know, I was brand new. I was 20, 21 maybe. I had a full head of hair. I was wearing a really nice cheap suit. I was working at this Ford dealership, and the general manager's name was, I'll never forget, is Morris Hamilton, and he looked like Sean Connery, handsome, put together, tall. He had the silver tongue, right? And you know, I was working on this client. I was going to sell him this Ford Explorer, and he goes, "All right, listen, we're going to go in that room, and I want you to sit over there, and I want you to just listen." And he sits down, and the people are across from him, and he's just laying it out. Boom, like why you should do it, benefits, everything. And I'm listening to him, and I'm like taken by him. I'm like, this guy I would buy the thing, right? Personally. And I like, all of a sudden I started talking. I'm like, yeah, that's right. And you could do this, and you could do that. And then he looked at me and he goes, Michael, he goes, excuse me. And he brings me out in the hallway, and he literally grabs me. I mean, I was 160 pounds then. It was nothing. And he grabs me and he kicks me up and he puts me against the wall and he goes, God gave you 2 ears and 1 effing mouth for a reason. You listen twice as much as you talk. I was like mortified. That's stayed with me a very long time, obviously.
Yeah, that's a good one. I think I've had that by my pops do that, choke me up and say the same thing. Yeah. God gave you 2 ears and 1 mouth. So no, I love it. That's the biggest thing. Listen and help people and find the problems. So with this amazing Fed rate drop and all the mortgages rates obviously going lower, like we just talked about. I mean, obvious, because the Fed's cut the rate. Are more people going to sell their house? Or is there going to be a buying frenzy?
Right.
Is there going to be?
Well, everybody thinks.
What does that mean?
My clients all think that house prices are going to go bananas, and there's going to be even less houses on the market because rates are dropping and people are going to buy everything up. Is that what you're hearing?
I hear a lot of different things. I hear it's going to flatline. It's going to be stable. I hear that people are not going to want to sell, but we're relying on home builders picking up the pace and everything like that, and still catching up from being behind COVID. I haven't heard of a lot of people wanting to sell, but that makes sense. You know, if they can go get something at a lower rate and give up, whether they're downsizing or upsizing or whatever, that would that makes sense that might pick up as well. Create more inventory, I think, regardless, is what we need and what will happen.
I agree with that. I think there'll be more inventory. I don't know what it does to prices, but there's, pent up demand for home sellers because they haven't sold. Because where are you going to go? Home prices have shot up. So if you're going to sell your house and capitalize on the appreciation, you're going to turn around and give it back on the next house. And you're going to take your 2.69% mortgage rate and trade it for 5.5 or 6%. That doesn't feel great.
Awesome.